Hi there, welcome to Kneppy Invest. We are midway through December, so only 2 weeks to go before the end of the calendar year. And I have quite a few more financial year 23 result videos to do, viewer inspired. In fact, I put all the requests on little pieces of paper and I've been drawing out the order I do these videos by drawing out of the hat. And I still have a lot to go through, many to go through, and which means I have to get a bit of a step on doing these videos. So I'm doing John's Lyng Group today, and then I will try to do the rest of these videos within the next few months. More than likely, not before we see the half year or full year results released in February. I had hoped to get through this by then, but at this point in time, it doesn't seem like I will. Now, typically on Fridays, I will release a week that was a video. However, I'm in between night shifts. I haven't prepared that video just yet, and I have a few things to go through on Saturday. So I'll release that video on Saturday, the 16th of December. So let's talk about John's Lyng Group, a company I actually do own in my portfolio. I do think this is a potentially high quality company in the future. You could even argue right now it is a high quality company, and it's been on the ASX for about 6 or 7 years and has done very well since it's listed. It is expanding internationally. It now has services in the United States. Now, a lot of people, investors, are wary of companies, Australian companies in particular, expanding overseas into America because many of those expansion plans actually fail in the long run. But at this point in time, it looks like John's Lyng Group's expansion plans are, are looking quite good at this point in time. So John's Lyng Group is Australia's leading integrated building services provider. So just think of a natural disaster happening somewhere, flooding or maybe a big storm comes through, fairly big size population. For instance, Lismore and the floods, and this is where John's Lyng Group comes into play. They work with insurance companies. The insurance company says, "Hey, can you go and restore some homes, that sort of thing." So Australia's leading integrated building service provider, delivering building restoration, strata, and energy services nationally and internationally because of operations in the United States. Now let's have a look at the financial year 23 results. Also have a look, they have a few divisions or segments, but most of the revenue is derived through one segment. And I'll touch upon that later in the video. But revenue, $1.28 billion, up 43% from last year. Now this company has acquired some other companies recently, the last few years. So not all of that is organic, but pretty good organic growth for this company. I think they also announced a partnership with Tower Insurance in New Zealand quite recently. Share price did not react to that. However, look at the profit, $47 million, which is up 88% from last year. So this company does exist on pretty low margins, which makes sense because construction restoration, you would think pretty low margins, but probably a little bit higher margins than some other construction companies. So I would not put John's Lyng Group in the same category as those construction companies. In fact, I would never consider those type of companies to be high quality. And I can definitely see the argument that John's Lyng Group is a high quality company. So gross margins, 21.4%. So it's not like a SaaS company, software company with gross margins above 90%. So we don't expect that for this type of company. Operating cash flow and free cash flow is significantly higher than the profit. So there are reasons behind that, which I might touch upon in this video. Wait to see for that. Operating cash flow, 140.7 million. Free cash flow, 127.5 million. So if you do any sort of valuation metrics and you focus on the operating cash flow and the free cash flow, John's Lyng Group actually looks much better value than if you just focus on the profit. And this company has net cash, 72 million, which I was a little bit surprised, even though I'm a shareholder of this company. I expected a little bit of debt there, but $72 million of net cash, and that can only be a positive in my opinion. 278 million shares on issue, which means our share price of $5.90. I haven't actually looked at the share price today on the 15th of December. That means the market cap of this company is 1.6 billion. Yes, Sometimes I don't check the share prices of companies I own for quite a few days, particularly if they're in my high quality portfolio. I have no idea how some of these companies did, even though we had a really good day on the ASX. I think the ASX was up, or the XJ was up about 9 or 0.9%. Equity 394 million, up from 333 million last year. So I do look at equity. And one of the reasons I look at equity is because I want to see equity increasing, but also because one of my favorite metrics in understanding or determining the quality of a company is return on equity. So you need equity for that. And return on equity for this company is 11.9. But again, if you focus on the cash flow, um, and I have never heard of a cash flow on equity that or return on equity that's focused on cash flow. Can't think of one. That return on equity would be high, but 11.9 is exactly what I want. I want to see that above 10. Preferably, I'd like to see return equity above 20, but I'll take 11.9 and also take return on invested capital of 13.4. Dividend yield 1.7%. I am not an investor in this company for the dividend. In fact, I invest in no companies because of dividend yield. It's just a benefit from owning some of these companies, particularly if I'm owning a company I think can grow and they also have a nice dividend yield. That's just an added benefit. So I never invest in companies just because of dividend. I invest in companies because I think they can grow in the future. And one of the best ways to really increase your wealth is to buy companies that are growing not only their profits, but also growing their dividend over time, which is one of the reasons I will never invest in Telstra for the long term, while I'll never invest in the banks for the long term. Even a company like Woolworths won't grow all that quickly. Those companies are probably okay for retirees who want income now. For me, I don't need income now, so I don't need to invest in those type of companies. Now to the valuation metric. So yeah, if you just focused on P ratio, you might say, well, 34 seems a little bit too rich for me. This company is expensive, and I prefer to focus on valuation metrics like enterprise value to operating cash flow or even free cash flow yield. Now, free cash flow yields is something I want to study a little bit more because I have found a few research papers that do suggest it is one of the most powerful valuation metrics in regards to whether a company can outperform the market. Yes, free cash flow. Why can I say free cash flow? Free cash flow yield. Another one is revenue per share growth, which is something I do focus on. But if we focus on the EV to operating cash flow, 10.7. Now, typically that metric, I look at a range between 6 and 10. If I see a company between 6 and 10, I probably would consider that company to be possibly good value. So for John's Lyng Group, that is 10.7. So possible, interesting value for this company, a company that is growing at that. And free cash flow yield, 8%. That's pretty nice. That's really nice, in fact. So if you focus on operating cash flow, free cash flow, you probably have the argument that John's Lyng Group is definitely not overvalued. You could even argue that it might be undervalued. Did I say overvalued? You'd definitely not say that this company is overvalued if it goes focus on operating cash flow and free cash flow, but you might have the argument that this company is undervalued and also did a reverse DCF based off the free cash flow. I could have done it on the earnings per share, but just based off the free cash flow, all this company has to do to justify the current valuation is grow their free cash flow at 6.1% per year. And I definitely think this company can do that. This company has shown pretty good growth over the past 5 years or so. And I think I do have a slide on that growth over the past 5 years. So I definitely think John's Lyng Group can achieve that sort of growth in the next 5 to 10 years. One thing I like to look at for most companies, particularly if they have different segments or divisions, is disaggregation of revenue based off those divisions, segments, and also international. Now, I'm not doing that with John's Lyng Group in regards to the United States performance, but United States performance is doing fairly well right now. So on this particular slide is straight from the company's presentation of their financial year results. They've broken down the business into two sections: insurance building and restoration services, or IB and RS, and commercial building and commercial construction. Now, when you look at the revenue, $1.146 billion in IB and RS, and only 71 or 131, $130 odd million in the other section. So by far, the majority of this company's revenue is through insurance building and restoration services. And they've also listed on this particular page all their subsidiaries, that sort of thing. So we're talking about Johns Lyng Group, or Johns Lyng Make Sure Builders, Steamatic Restoration and Cleaning, Reconstruction Experts, Link Fire, Smoke Alarms, Johns Lyng Group Energy Services, Restorix Services, Johns Lyng Aztec Services, Trump Floor Coverings. I wonder if that's anything to do with Donald Trump. Probably not. Air Control Australia. So a lot of little subsidiaries here. Also, on this particular page, they talk about exactly how they get revenue. For instance, building, fabric repair and contents, restoration after damage from insured events, including impact, weather and fire events, disaster and catastrophe response for insurance companies and governments, hazardous waste removal and emergency domestic household repairs, strata and property management, essential home services, including smoke alarm, compliance and fire safety services. But when I think of Johns Lyng Group, I just think of that restoration after damage from impact of weather and fire, that sort of thing. Now, now let's have a look at the financial history of this company going back to 2014. The reason we have informational data going back that far, even though this company listed on the ASX 2016 or something like that, is because when a company lists on the ASX, typically they release the last 2, possibly even 3 years of financial information. So on this particular slide, I've included revenue history. So this is not revenue per share, just plain revenue. Also gross margins. Now, one thing I look for is revenue and revenue per share increasing through time. And that is definitely true for Johns Lyng Group. In fact, their revenue has increased 6-fold over the past 8 years. Now, some of that is through acquisitions, but also through organic growth. And revenue has really accelerated over the last few years. So more than likely, one of the reasons they decided to list on the ASX is to gain more access to capital. And if that's what they've done, and the reason they did that, they've been successful. So management have been successful of driving growth in this company. You just see that with the revenue growth from even 2018, from 300 million to 1.3 billion. So revenue over the past 5 years has increased about 4-fold. So the other thing I've looked at for companies is gross margins, any sort of margins. And the main thing I don't want to see is any sort of margins decreasing through time. That's actually a bad sign. So gross margins for Johns Lyng Group is fairly steady. So even though you see gross margins here going up and down fairly violently, it looks like, in fact, it's only within a 2% range over the past 8 years, between 20 and 22%, right now at 21.5%. If I start to see gross margins increasing above 22%, that's actually a really good sign that this company is, I won't say has a moat or anything like that, but, or even a competitive advantage. Probably a competitive advantage, I probably would say, and more than likely, it will just be the name. People are aware of the name. Insurance companies are aware of Johns Lyng Group, that sort of thing. And that would be a good sign that this company is even better quality than I'm thinking right now. Now, I think I mentioned earlier in the video that this company has seen really impressive growth rates over the past 5 years or so. And this is straight from Guru Focus. So I'm trusting the numbers here. So and this is per share growth. The most important thing you look at when you're looking at growth of a company is looking at per share. You want to see, particularly for a shareholder, you want to see what the growth in a company's revenue, earnings, free cash flow, dividends, book value, and price is for your shares, not for the company itself, because sometimes a company can grow their revenue, earnings by just increasing the amount of shares on issue by doing massive acquisitions. So focus on growth rates per share. So over the last 5 years, revenue has grown at 28.8% per year, earnings per share at 24.5%, EBITDA at 35.4%, free cash flow at 26.7%, book value at 59.9%, and total return at 47.5%. So all these numbers are really impressive growth. Now, if you look at the last 1 year, still really impressive growth, but look at that total return. It's actually return for shareholders has actually gone backwards over the past year, negative 14.7. So this company is looking much more attractive right now than it was 1 year ago, just by comparing the growth to the price total return. And you can definitely say that Johns Lyng Group right now, as I speak in December 2023, is attractively valued, particularly compared to last year in 2022, by comparing the PE ratio of this company to its historical levels, also the enterprise value to free cash flow. So what's happened with this company over the past year, even 2 years, is this company has seen financial expansion. So revenue, earnings per share, free cash flow have all grown over the past year. But at the same time, multiple contraction. So P ratio of this company back in early 2022 was 100. Now it's just above 30. And also the EV to free cash flow was in a similar range, and now it's just above 10. So when you see a company have financial expansion and that's at the same time multiple contraction, that means more than likely the company is going to be much better valued than it was in the recent past. And that's exactly what you see here for Johns Lyng Group. Now, moving forward, what we want to see is a company continue to expand financially, but also we want to see some multiple expansion as well. We want to see P ratio climb, EV to free cash flow climb as well. And that's when you really get a super hit to your returns over time, if those two things are moving in the right direction for you and the company. Now, let's have a look at the chart for Johns Lyng Group. This goes back to when the company listed on the ASX back in 2017. This is the weekly chart, and a beautiful looking chart, particularly from the middle of 2018 to the start of 2022. So over a 4-year period, share price of this company went from about as low as under $1 at the end of 2018 to $9.25 in the first few months of 2022. Now, looks like just based off the share price is at a pausing range or consolidation period, share price going sideways, a little bit of volatility in there. But even though the share price has fallen by about 30 to 40% since those highs, because this company is continuing to grow quite quickly, that's the reason why this company is now looking quite attractive based off valuation metrics. The next 5 videos I plan to do in this particular series include PolyNovo, a company I have done a couple of videos, standalone videos on, but I'm really looking forward to doing a follow-up on PolyNovo. I really like the space they're in, and I don't think they're yet profitable. But even though they're not profitable, the valuation of PolyNovo is quite high. So I'm really looking forward to just see how that company has been performing over the past year. And then DGL, a chemical-based company out of New Zealand. Share price of DGL has been hammered over the past few years, but is there any value in that company right now? Is it a possible deep value play? So looking forward to do a video on DGL. And then LaserBond, a company I do own in my small cap portfolio, and hopefully I'll own LaserBond for a long time, because if I own it for a long time, more than likely the company has performed admirably over that period of time. And then Sunrise, I think it's Sunrise Rice, unusual ticker code. So I'm really going to enjoy exploring that company and trying to understand why the ticker code is SGLLV. I eat their products, but I have never looked at Sunrise Rice. And then finally, Coventry Group, small cap company. Not sure exactly what they do, retail, that sort of thing. But the chart does look interesting for Coventry Group. That's all I have for this financial year 23 result video for Johns Lyng Group. I do have a hard time saying this name because it's Johns Lyng. If it was John Lyng's Group, I'd probably have an easy time doing that. But Johns Lyng Group has really grown over the past 5 years since they listed on the ASX. And even though the share price or the chart doesn't look as good now as it did between 2018 and 2022, just the fact that this company has grown quite well over that period, and I think that growth can continue, maybe not as strong as it has during that 5-year period, but definitely double-digit growth, earnings per share growth, revenue growth, free cash flow growth. And if it can achieve that sort of growth, I think this company is looking attractively valued right now. So if you have any questions about Johns Lyng Group, any other companies you'd like to see me do a video on, not in this particular series, because I'm going to cap it at those companies I have in my hat right now, but maybe you'd like me to do a video on a small cap company or any sort of company, just leave your recommendation in the comment section of the video and I'll see what I'm able to do. Who knows? Maybe I'll do a short video on that company. So otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.